What role did interest rates play in the COVID-19 market crash? Imagine a sudden storm hitting a busy city, causing chaos and confusion. That's similar to what happened in financial markets during the COVID-19 pandemic. Interest rates played a big part in how this storm unfolded and how markets recovered. When the pandemic started in early 2020, investors saw a lot of uncertainty. Stock prices dropped sharply, and markets became very volatile. To help, central banks like the U.S. Federal Reserve quickly lowered interest rates to nearly zero. This meant borrowing money became much cheaper for businesses and people. Lower borrowing costs encouraged spending and investment, which helped ease some of the panic. At the same time, the pandemic caused a huge demand for cash. Many companies and banks faced liquidity shortages, meaning they didn't have enough ready cash to meet their needs. The Federal Reserve stepped in by buying large amounts of government bonds and mortgage-backed securities. This injected money into the financial system and kept long-term interest rates low. These moves helped stabilize markets that were freezing up due to the crisis. Lower interest rates also made stocks more attractive compared to bonds with very low yields. As rates dropped, investors started shifting their money into stocks, pushing prices higher. This was part of the reason markets began to recover from their lows starting around April 2020. The rate cuts also signaled that policymakers were committed to supporting the economy, which boosted investor confidence. Before the pandemic hit, there were signs of trouble in interest rate markets. The U.S. Treasury yield curve, which shows the difference between short-term and long-term interest rates, briefly inverted in 2019 and early 2020. An inversion means short-term rates are higher than long-term rates, often seen as a warning sign of an upcoming recession. This reflected fears about economic slowdown even before the virus spread widely. In summary, interest rates influenced the COVID-19 market crash in two main ways. First, they reflected economic fears through the yield curve. Then, central banks responded by cutting rates and injecting liquidity, which helped prevent a total collapse. These actions played a key role in stabilizing markets and setting the stage for recovery.